any churn is bad churn.
But the churn that you don't control is less bad.
Why are we being so conservative? 3x? Is that the best we're hoping for here? Is making 3 times what it costs us to acquire customers?
But they're all slightly different. And to lump them into one term does seem a bit simplistic. I will stop doing that now.
But I think the question, Rogan, was how is the business model disruptive? I haven't seen any disruptive business models.
But the entrepreneurs that I want to invest in most are those who have a vision of how they're going to get from A to B.
So business model means how are you going to make money? We cut to the chase on this, right? How are you going to be able to take the product, the service that you have and extract value from it? And in this case, we have to be quite capitalistic about it. Value longer term extracts to money and revenue and profits. And so I think business model is a catch-all term to encompass all those various bits of it. And I think at different stages of your company's lifestyle, there'll be different things that people focus on when they talk about the business model.
It's actually a very good question because I've never really thought about it before, but it's an utterly meaningless business model does cover all of those things you said, VK. So I think probably that question was spot on. VC should be much clearer and say, what is it that we want to talk about? And it is all the aspects that you say. It's virality, it's how do you make money, it's all of that. If you're disrupting an industry, you are obviously doing something that currently the industry doesn't do. Okay, who are the customers who are going to benefit from this? What does that mean in terms of the impact on their spending and where it's going to go to? And as a consequence, who's going to lose out?
I think we kind of know coming back to what I said a little while ago, we know what the general 5, 6, 7 kinds of ways of making money are. And so we look at the business, we try to understand kind of what is the value that is there for the consumer. And then from that, the business model should flow relatively easily, right? So if it's a social mobile app, you kind of get long-term what the business model is going to be. There's going to be a data play, there's going to be an advertising play. If it's an e-commerce company, it's quite simple. You know how they're going to make money. If it's a SaaS business, you know how they're going to make money. So when companies come and pitch us, we kind of all know what the business model is going to be. I guess what we look at instead is this an engaging product? Is this something people would value and therefore give their money or their time to it?
A lot of this is also helping us assess the founder. So we're not going to start second guessing how things might change or whether they might change. But what the founder says about their view on the business model, or how they're going to make money, I find a fascinating insight into that founder's mind.
But the reason VCs like business models for very early stage companies, we want to see how founders think. I will chime in here because I have a very good story about this. So we were fortunate to be investors in a company called TweetDeck, which ended up being bought by Twitter for very good return for founders and investors. But I remember having a conversation with Ian, the CEO, and he said, what you guys have to understand is we're a business built on a business without a business model, because they were leveraging the Twitter platform at the time, and at the time Twitter didn't have a business model behind it. So we're a business built on a business without a business model. But in that case, actually we all knew what the business model for Twitter was going to be, right? We knew this was a company that was getting huge amounts of attention and time from a very large number of individuals. We could see the value in the network that they were building. And TweetDeck enabled that business. And so we knew the business model would be the same as Twitter's, which was clearly going to be advertising and a data play.
Can't argue that. We're using business model in way too broad a sense. So what we're talking about here is, what is the way of making money? But other bits of the business model, as you touched on, were unit economics, stuff like that. So I think we do want to have some clue about that the founder can kind of think in those ways. But as Sean says, you could have no revenues at all, but there still has to be a plan at some point to get those revenues and to make them at a profitable margin.
I will confirm and then add to it as well. So I think the way to think about every round of financing is you have to prove one thing. With that one important thing with that round of financing. So when you go to market again, you can raise capital at hopefully an up round. And a lot of times for seed and A, it's actually not about the long-term economics of the business, right? You're trying to prove in the earliest days that you've got a product people like, which I think I mentioned earlier. And then you've got the next thing is prove that you can actually scale the sales of that product, get that product into more and more people's hands. And then beyond that, I think comes the idea of extracting the most amount of margin or most amount of revenue, right? Now, if you are a mobile app, it's actually more about the first two. If you're an e-commerce product, it's more about the end one, because in the end you have to, buy and sell with a margin.
So that second one, what's interesting is arguably, if you consciously, which I think is the question, leave value in inverted commas on the table, you're probably doing that to create further value in the future.
For businesses, there are certain times when you're actually looking to, I don't say upend the business model, but actually change an existing business model that people have. So I think about some of the trading platforms, stock trading platforms in the US. So typically, trading platforms made money by charging a commission on every trade. And then in the last few years, you've had Robinhood and others come in and basically offer free trading. And so that is purposely taking all of that kind of rent and surplus back to the consumer. But longer term, let me tell you, they will have ways in which they're going to monetize. And they're not going to be innovative and new. They're going to be leveraging kind of minute spreads or data or whatever else it might be.
I've heard that number too as well. And I don't really understand what it's talking about. If you have 2x LTV CAC, you can still make money. I don't know what is so special about 3x myself. The real thing I think one should be looking at is how you manipulate those two in the direction you want it.
Why are we being so conservative? 3x? Is that the best we're hoping for here? Is making 3 times what it costs us to acquire customers? If you've got a product that people really value, it should be, I don't want to say an order of magnitude more, but Facebook spent next to nothing to acquire me, and they've been monetizing the hell out of me for the last 15 years.
In fact, I'm delighted if somebody identifies that they've got a negative gross margin and then identifies the reasons for it and identifies a cogent argument about why it might change. The entrepreneurs that I want to invest in most are those who have a vision of how they're going to get from A to B.
And following up on that, I think one of the most in-depth conversations that we have as VCs when we look at a business is we break down the components of the business model and we try to forecast. We say forward-looking, in a year, in 2 years, in 5 years, what changes about that individual component? So are you able to charge a higher price? Can you negotiate with suppliers? Does your distribution costs come down? Does your warehousing costs come down? And you look at each individual component and you try to forecast in the future, what does the business model look like at that time? Good churn is no churn. Honestly, right? The number one everyone talks about is the net retention number, negative net retention. So basically, you are not only keeping all your customers, they are spending more and more money with you. And there are all kinds of frameworks you can look out there for these. But I think for an early stage company, every churn should be analyzed. Every company that stops using your product, you need to speak to them. You need to understand what it is that made them decide not to pay again for it.
But the churn that you don't control, i.e. company goes bust or in a consumer situation somebody dies, is less bad.
Fascinating.
We've been having this discussion about capital structures just recently.
We've been talking a lot about different ways to fund companies. So the before diving into the various forms, what I will say is one thing to think about is when you take on venture financing, the potential outcomes for your business change. We make money by you making an exceptionally large amount of money. And our business model is such that there will be a number of companies we invest into that don't work out. And so we will push your company to generate an exit that is in the hundreds of millions, billions, tens of billions of dollars. A company selling for $30 million, euros, pounds, doesn't actually do anything for our economics. And so we would rather push you beyond that with the risk of the company not making it and take an exit at that level. So I always counsel founders, think hard about taking VC financing because it does change the potential outcomes, the range of outcomes. If you're a sole founder or a founding team, no venture money and sell the company for 30 million, that's absolutely fantastic. If you raise venture financing, sell for 30, that's a disaster.
Should you take other forms of funding? I think venture debt is a great way of getting non-dilutive funding.
I have nothing to add.